Last week, the Obama administration dove headlong into an energy-related piece of that financial reform. Many blamed derivatives for the record-high oil prices we saw back in 2008. And ever since then, Congress has talked about stopping speculators. In fact, the House passed a bill, and Senate Democrats leading the Agriculture and Banking Committees negotiated their versions with Republicans. Now, President Obama says it is time to decide, and he won't sign anything full of loopholes. Clean Sky's Margaret Ryan explains.
Derivatives are used as insurance by companies whose business would be ruined by big swings in energy prices. But the big banks and traders writing those derivatives also use them to make money. They bet on how energy, currency, and other prices will go. President Obama stepped squarely behind forcing most derivatives trading into regulated exchanges or clearinghouses where prices will be public.
We cannot have a circumstance in which a meltdown in the financial sector once again puts the entire economy in peril.
We need to bring derivatives out of the dark so we don't have future AIGs. We saw what devastation that caused when you let huge complex companies write hundreds of billions of dollars of commitments in derivatives without the capital to back that.
Gary Gensler, chairman of the Commodity Futures Trading Commission, warned against Congress exempting some players from the new rules.
That we not enact broad exemptions for particular classes of contracts based on which party stands behind them. And I know this has been a very open and I think a very healthy debate around whether some end users should be out or in the clearing requirement. I believe that it's important to note, though, that the American taxpayers were not required to cover any market exposures on the cleared futures transactions. They were required to put in $180 billion to AIG.
Regulation opponents say energy derivatives can't be standardized because companies' risks vary widely. They say U.S. regulation will just send the derivatives business overseas.
We've been working very closely because of that potential challenge to make sure that European countries and others are moving with us and put in place a complementary framework, very similar protections. And we have very broad convergence with the Europeans on what we think will be an effective global framework that will avoid that risk.
But Republican leaders warn the Democratic bills will just make things worse.
If you look at it carefully, it will lead to endless taxpayer bailouts of Wall Street banks. That is clearly not the direction the American people would like for us to go, and also not the direction Senate Republicans would like to go.
I am absolutely confident that the bill that emerges is going to be a bill that prevents bailouts.
The President was very, very clear with the members this morning. He is happy to listen to, happy to work with, and happy to incorporate any ideas that strengthens financial reform. But we are not going to make bad policy decisions through the artificial lens of hoping something is bipartisan.
The stakes are enormous for the biggest Wall Street banks, an estimated $20 billion in trading profits just last year. The Senate Banking Committee has passed one reform bill, but last week Arkansas Democrat Blanche Lincoln said she'll offer a bill that's even tougher on derivatives. But like climate, the big question is, can legislation this divisive get passed by the Senate this year? In Washington, Margaret Ryan, Clean Skies News.
That 2008 record run for oil prices that we mentioned was the main selling point behind the Pickens Plan, a national energy strategy pitched by Boone Pickens himself. Well, last week the legendary oil and natural gas man appeared before the House Ways and Means Committee discussing tax credits for energy production, sources like wind, ethanol, biodiesel. But Pickens wants to add another kind of credit, $65,000 for truckers who convert their diesel-powered big rigs to run on natural gas. After that hearing, Pickens talked with Clean Skies News.
Our approach is very simple. I mean, we are hunting with a rifle. We are aimed at the 8 million 18-wheelers and the 65,000 in cent. So I don't see anything complicated about it. Standing alone, it'll pass in a minute, I promise you. We've got 141 co-sponsors for the bill, but right now they're holding it back to put some other stuff on it, which I'm watching that very closely, and I don't want any tax problems to come into the industry.
Pickens tells us the tax credit is needed to offset initial conversion costs. They can run as high as $80,000 for an 18-wheeler. But according to Pickens, owners of some trucks could recoup their cost in fuel savings in just about 4 years. Along the way, they could also cut U.S. diesel demand by about 5% each year.